Now, if your trading account is not healthy, more red than blue, then there must be something you are missing from your trading account. So today I'm gonna discuss that missing piece of the puzzle that one must know to be a profitable trader. Now I know that retail traders are not much interested on trading psychology, but as a matter of fact, to be a consistently profitable trader, one must have developed a strong trading psychology. So to develop that trading psychology, so I'm going to discuss with you today the most important trading rules one must know to be a consistently profitable trader and to develop a sound trading psychology. If this is something you are interested, then smash the like button, hit that subscribe button if you haven't done yet. This is Forex Wizard from Forex Trading Wizard Academy. Without further delay, let's get started. Okay guys, so let's begin with the rule number one is discipline. Now this is where most traders lacking, not having proper discipline. Okay, so what is in fact a discipline? Discipline includes a wide variety of things. For example, probably you are on a train or a bus or riding a bike and suddenly you open your phone and you saw that there is a market is moving, looks like there is a trade, and you start to take the trade on the go, on the bus, train, or even when you're driving. That is a bad trading psychology, because trading requires a lot of attention, analysis and proper judgment before you open a position, and it requires a cool, relaxed environment. And I did in the beginning too. When I started trading, looks like that, okay, it's easy, let's take the phone and open a trade, and then just to see that when I has come back home, analyze the chart, and I realized that, okay, this is not the trade that I should have taken, then why did I take? So this is all because trading, whenever I'm thinking that there is a trade, so there has to be a specific time allocated to open a trade. Probably even if you miss the trade, that's fine. Okay, this is the best practice, is to wait for the right time. So when you are relaxed and have enough time to analyze the chart, to make the decision, and then to trade. So this is the first thing that as a trader, one must know, is to trade on a specific time in a relaxed environment. Now, another mistake that I also made when I started trading is sitting down on the trading desk whenever I feel like I have time, or sitting down for a very extended period of time. This is also a mistake, because trading requires a high level of attention and discipline. It is always good to trade in the same time every day and in a specific period of time, because especially if you are in front of the chart for very long time, that by default we convince ourselves to take a trade which is not there. Because when we look at the chart for very long time, we tend to lose our mind and we start to feel bored and feel like that I'm not doing anything, I'm spending a lot of time not gaining anything, and then I started to see the trade which is not there. It is a very common practice. So it is important that you allocate specific time, either you trade or don't trade. Afterwards, get out of the desk, do something else, and then next day or in the next time come back and sit down. So another mistake that trader does is sitting down on the trading desk in different time. For example, today 9 o'clock, tomorrow maybe 10 o'clock, or maybe today 3 times, tomorrow 1 time. Instead of that, what is the best practice is to sit down in a specific time period, and then forget it. This is how you can develop a very strong sense of timing, how the market moves on that specific time. For example, if you're trading on a London session opening, you will see the market behave in a certain way. And once you do that every day, then you will see that in that timing, the market behave in a certain way. They started to recognize that, which is very, very important as a trader. Now, rule number 2 is to have a proven, back-tested trading strategy. Now, without strategy, trading is like a gambling. Now, let me show you an example of what happened when we don't have a strategy. Imagine that you are trading euro dollar, okay, and then you saw that suddenly the price started to drop from this level, breaking this support level. Okay, now once the price started to break from this support, you feel like, okay, the market is breaking down, the market is dropping, I'm gonna short from here. Okay, you're gonna sell from this zone, stop loss above the candle, and then just to see that the market has come down and then has gone up to hit your stop loss. Now, not having a strategy, the biggest disadvantage is that whenever the market make a big move, we feel like trading, okay, because we feel like the market is moving, the market is going somewhere, I need to take that trade. This is the tendency that happen when you don't have a rule-based strategy. But having a rule-based strategy, you know exactly when to enter. That will eliminate the confusion from your trading. You know that the market is moving or not moving, doesn't matter. I have a strategy. For example, you might say, okay, if the price crosses 10 and 20 EMA in that way, in this direction, and then closes back below with a specific price action pattern, and only in that case I will be trading. Now, this is why we use our strategy. As you can see, we do have a strategy. You can see in this whole move on euro dollar, there is only one trade that we can see giving the sell alert, and you can see this whole move from that zone. Euro dollar has a massive drop. This is the strategy. This is the power of having a strategy, that not being confused with this one, that one. I only have one zone, and from there I'm gonna trade. This is how the power of the strategy that will help you to eliminate the emotion coming from trading, or any kind of fear and greed that normally clouds our judgment, and we tend to make bad decision as a trader. So having a rule-based strategy is the key to eliminate the gambling psychology from trading, and to develop a proper sound trading psychology. Now, the third or final, and I would say the most important rule as a trader, is risk management. Now, risk management, I know that almost 90% trader are very poor in risk management, and because of that 90%, 95% trader lose their account money. Risk management is a vast subject in trading. So risk management includes lot size calculation. This is one of the most important component of risk management, finding out lot size based on your risk percentage. Now, as a trader, you must know how much you are risking on a single trade, and based on that risk, you need to find out what lot size you are going to buy or sell. Because if you randomly buy or sell always same lot size, then for different stop loss pip, you're gonna lose or win different amount. That will bring inconsistency in your trading account. The consistency is that every trade, for example, I'm gonna lose this much, I'm gonna gain this much. Okay, this is the consistency. Let's say every trade you're gonna risk $100, you're gonna gain $500 or $300 or $200, and you're gonna always lose the same amount and gain the same amount or more. Will give you a consistency in your trading account. This is the key to be successful trader. Now, another part of risk management is not to over trade, FOMO trade. That's all part of the trading psychology, and also over trading will risk your account. So how do you eliminate over trading? Now, over trading happens especially when we lose couple of trades and try to recover that losses. This is a very common mistake in trading psychology. When I begin in a single day, sometime I open 10 trades, 15 trades, just to realize that now why did I open that many trades? I saw that if I open selected few trades, that could give me huge profit. Just the bad trades has eaten all the profits from the good trades. So you need to develop a strong risk management plan to reduce over trading. For example, if you saw a trade on AUD USD, now you might see a trade on euro dollar, and then you say a trade on gold, and then a trade on dollar CAD, and then trade on USD CHF, and you open all of them. In fact, you thought that you open a trade with 2% risk, but you open $5 trade that in fact going almost behaving in the same way. You are risking 10% on a single trade. This is called over trading. And then you start to see another trade and then another trade, and then indices, crypto, forex, bunch of trade, and then just to see that your account is blown. Now, another important aspect of risk management is to use risk management tool. Now, you can open your mobile phone and press the button and open a trade, but you need to have a specific tool to open trade. If you are using the desktop, then definitely your platform, either you are using MetaTrader 4 or any kind of platform, or TradingView, every platform has their own risk management tool, and you need to follow that tool to open position based on risk percentage you set for that specific trade. Now, these are the 3 most important rules that one must master to be a consistently profitable trader, to develop sound trading psychology as a trader. I strongly believe that these 3 rules is helpful to you. Make sure you note down and try to follow them to develop a strong trading psychology so that you can grow as a trader. Thank you. I'll see you soon in my next video.